Hello, fellow compounders. Welcome back. Today, we're going on an eye-opening journey debunking some of the most common myths about dividend investing. Dividends are a key component of investment returns, but there's a lot of misinformation out there. Whether you're a seasoned investor or just starting out, understanding these myths is crucial for making informed decisions. So let's get started. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you are responsible for your own financial decisions. Myth number 1. Dividends as a sign of health. Our first myth is a big one. A company paying dividends is always a sign of financial health. It sounds logical, right? If a company is sharing profits, it must be doing well. But this isn't always the case. Let's unpack this with a real-world example. General Electric, or GE. For decades, GE was a beacon of stability, known for its reliable dividends. But in 2017, amidst declining profits and a ballooning debt, GE shocked the market by cutting its dividends to just a penny, 1 cent. Investors relying solely on GE's dividend history as a sign of stability were caught off guard. This event was a stark reminder that the dividends alone don't paint the full picture of a company's financial health. But GE isn't the only example. Consider Kinder Morgan, a giant in the energy infrastructure sector. In 2015, despite its size and market presence, Kinder Morgan slashed its dividend by 75%. The culprits, a combination of high debt and the impact of falling oil prices. Investors who equated high dividends with security were in for a rude awakening. These cases underscore a critical point for dividend investors. Always look beyond the dividend. Analyzing a company's debt levels, cash flow, industry trends, and future growth prospects is essential. A dividend might be sustainable today, but what about tomorrow? It's not just about the ability to pay dividends, but the ability to sustain and grow them over time. As we've seen, dividends are not always the reliable health indicator they're believed to be, but that's just the tip of the iceberg. Myth number 2, high dividend yield is better. Now, let's tackle a very tempting belief. A higher dividend yield is always better. It's like seeing a big for sale sign. It grabs your attention, but as we'll see, a high yield can sometimes signal hidden problems. Take the case of Frontier Communications. Before declaring bankruptcy in 2020, Frontier boasted a very high dividend yield, attracting many investors. But this high yield was a result of the company's plummeting stock price, driven by a struggling business model and mounting debt, a classic yield trap. And Frontier isn't alone. Windstream Holdings, before its 2019 bankruptcy, also sported an attractive high yield. However, like Frontier, this was consequence of a declining stock price amid operational challenges and heavy debt. These instances highlight a crucial lesson, often a result of a dropping stock price rather than a sign of a generous company. So what should investors do? The key is not to get lured in by high yields without understanding the full picture. A sustainable and moderately growing dividend is often preferable to a high but unstable yield. It's vital to assess the company's overall financial health, business model, viability, industry position, and future growth prospects. A high dividend yield should be a prompt for further investigation, not the end of your analysis. It's about finding the right balance between a decent yield and a company's long-term stability and growth potential. So, high dividend yields aren't what they seem, but there's something more to the story of dividend investing. Myth number 3, dividend investing is conservative. Moving on to myth number 3, dividend investing is a conservative strategy primarily suited for retirees or cautious investors. It's time to broaden our perspective. Take Apple, a titan in the tech industry, known for its innovation and growth. Apple began paying dividends in 2012, and since then, it has consistently increased them. This debunks the myth that growth-oriented companies don't pay dividends. Apple's story shows that a company can be at the forefront of its industry and still reward its investors with dividends. Another example shattering this myth is Microsoft, Mr. Softy. As a leading tech company and growth stock, Microsoft stands out as a strong dividend payer. It has been increasing its dividend for years while providing a substantial capital appreciation. This combination defies the conventional view that dividend stocks are just conservative investments. And let's not overlook REITs, real estate investment trust. Take Prologis, for example, specializing in logistics real estate. Prologis offers both dividend income and the potential for capital growth. It has not only provided a steady dividend, but also significant stock price appreciation over the years. These examples challenge the traditional view of dividend investing. It's not merely about finding safe, steady income. Many dividend-paying stocks are at the forefront of growth and innovation in their industries. They manage to provide both the excitement of capital appreciation and the stability of dividend income. So, if you thought dividend investing was only for the risk averse, think again. It can be a dynamic part of a growth-focused investment strategy, combining the best of both worlds, steady income plus capital appreciation. As we debunk these myths, our understanding of dividend investing becomes clearer and more nuanced. Up next, we'll tackle a myth about the reliability of dividend income. Don't go anywhere. Our final myth for today: dividends are a guaranteed source of income. Let's unravel this with some historical context. The 2008 financial crisis serves as a classic example. Major banks, traditionally seen as the bedrock of dividend reliability, were hit hard. Bank of America, for instance, slashed its dividend from 64 cents per share to a penny a share. This was a reality check for investors who thought bank dividends were safe. It highlighted the impact of market volatility and risk on dividends. But it's not just during crisis that the dividends are at risk. The energy sector provides another perspective. Consider BP, British Petroleum, known for its high dividends. Following the Deepwater Horizon oil spill in 2010, BP suspended dividends for 3 quarters to manage liabilities and restoration costs. This situation shows that even industry leaders can face challenges that impact their ability to pay dividends. The recent COVID-19 pandemic further illustrates the point. Many companies across sectors, like Disney and Boeing, either reduced or completely suspended their dividends to conserve cash. These actions were responses to the unprecedented challenges posed by the pandemic, affecting even stable dividend payers. What these examples teach us is that dividends are not immune to external shocks and internal company issues. They're not a guaranteed paycheck. As investors, we must always be prepared for the possibility of dividend cuts and have a diversified investment strategy to mitigate the risk. Remember, investing in dividends is more than just chasing the next payout. It's about understanding the underlying businesses, its industry, and how external factors can impact its ability to pay and increase dividends over time. We've just reviewed 4 common dividend investing myths. But we're not done. We have a second video. So join us in part 2 as we continue debunking dividend investing myths. Please remember to like, subscribe, and share your insights and questions in the comments below. Remember to always be compounding. Thanks for watching. See you in the next video. Take care.